If you really want to be exceptional, there's no such thing as work-life balance.
Brenton Naicker is the principal and head of growth at Africa's leading blockchain-focused venture capital fund and accelerator. With deep expertise in Web3, blockchain technology, and cryptocurrency, Brenton provides valuable insights during our conversation.
Could you define what is Web3?
Web3 is really just a new way of doing the internet. Web 1 was the read era of the internet. Web 2 was what we call the write era. The blogs of the world, the social media platforms of the world. You were no longer purely just a consumer, you were a contributor. So Web 3 is defined as the read, write, and own era of the internet.
How would you define blockchain?
The best way to think about a blockchain is this general ledger where it's replicated so many places throughout the internet, and there's millions of copies. There's no one single person or one single entity that is able to influence that. If you're transacting on your favorite banking app, the bank can literally go into their servers and change your entire transaction history. With a blockchain, there is nobody in the world who has the power to change what's written on that blockchain.
Getting into crypto, now you're describing it as being an asset class, essentially. From the average investor, so young working professional, but where does diversification come into this?
The average investor, what I advise them, this is backed up by some of the largest asset managers in the world, is that
when you said that you are extra risky, how is your portfolio divided?
The financial advisors are probably going to have a heart attack, but my portfolio is roughly
Brenton, in this podcast, we're going to be speaking about blockchain, crypto, the future of business in Africa. In your opinion, who should stay till the end, either watch or listen to this podcast?
Well, I'd love to say everyone, but I think if you're an entrepreneur that is looking at building a business in the fintech space, and stable coins have really been, I think, the flavor of the month, so to speak, recently. If you're looking at a more efficient way to build a business in the financial services or fintech space on the African continent, I hope that this is going to be a very valuable session for you.
The crypto and blockchain space, how long have you been a part of it?
So I'm very privileged to have been in the space for about 8 or 9 years now. I think when I first got into the space, there wasn't really much of a South African or an African industry. So my first foray into the space was through fintech, where I was kind of project managing fintech projects for a large software development firm. Eventually, there started to be a bit of corporate interest from our clients in blockchain. At the time, those who have been in blockchain for a while will remember the whole enterprise blockchain craze. So things like Hyperledger Fabric, R3 Corda, and a lot of these corporates, because this kind of tech was developed by companies like IBM, they were really interested in experimenting with it. So I was privileged to kind of build out that division for the software firm. So I got a little bit disillusioned by the fact that, it was almost an experimental phase. So a lot of these corporates would build out a pilot, it would prove what it needed to prove, and then essentially the executives would just shelf it. So I got a bit disillusioned by that, and then started my first consulting firm, which was purely focused on the digital asset space. So kind of providing hand-in-glove services for high net worth individuals, family offices, people who really wanted to understand how do we allocate assets to the digital asset space or the crypto space, but also that kind of surrounding infrastructure, right? Your average kind of high net worth individual is not going to open a Luno account and deposit R1 million and just go click buy Bitcoin, buy Ethereum. So helping them interface with all the key stakeholders, things like custodians, like OTC desks, understanding key management, estate planning. So that was the first big break, call it, into purely on the blockchain space. And then ever since then, I've been really, really blessed to kind of do some really interesting things in the space.
Yeah, some of those interesting things include working for the South African Reserve Bank, Binance. You founded a few countries, you lectured at Africa Blockchain University. So I guess the question I have is, what interests you about the space? Was there this eureka moment where you're like, flip, this is the future?
So really interesting story, actually. There was a penny drop moment. In the industry, we call it orange pilling someone. So, similar to the Matrix analogy, you get the red pill and the blue pill. Bitcoin kind of added a third pill to the mix, and that was the orange pill, right? So, we spoke a little bit about my background, but kind of studied traditional finance with the goal of going into investment banking, right? Which I think the pure crypto audience are probably cringing at in the background. But that was the goal, right? My dream was to kind of get out of university, go work for one of the tier one investment banks, Goldman Sachs, JP Morgan. And during that time, I started to hear a lot of hype about this thing called Bitcoin, right? People were making a lot of money. And funny enough, my first thought was, this sounds like some sort of Ponzi scheme. But because I was in finance and obviously really young, so, I thought probably a bit too much of myself. I was like, I'm smart. I can figure out the loopholes here and probably make some money and get in, get out, quickly. So the first point of order for me was like, okay, let me understand this thing. So the Bitcoin white paper, if you haven't read it, I really implore everyone to please go and read it. It's counterintuitively, it's really short. I think it's about 8 pages. And I said, okay, the first step for me to figure out what the loopholes here are and how to kind of exploit them is for me to read this literature. So read the Bitcoin white paper. And because I had this background in finance where I kind of understood fractional reserve banking, how the financial system works, everything from credit issuance to money, a lot of the concepts just immediately clicked with me. And by the time I'd finished that 8th page, it was literally that simple. By the time I'd finished that 8th page, I was completely sold on Bitcoin. I understood the value proposition. I understood the problem it was solving. And its invention was actually a little bit of a political statement in the sense that everyone knows the kind of anonymous kind of creator, pseudonymous creator, Satoshi Nakamoto. In the first block where Bitcoin was actually published, the headline from the 2008 financial crisis was actually embedded in that block. So, what he was kind of, or he, she, or they were kind of insinuating was, this is a better, more transparent way to run a financial system. And that was the penny drop moment for me. Ever since then, the dream of being an investment banker had completely changed. And, at the time, like I said, there wasn't much to do in the blockchain space. So my first foot in the door was kind of through the fintech space, like I said.
What year was this when you first read that paper?
So this was 2017. So during the first big boom, I think, where Bitcoin had the run up from, a couple $100 to $20,000. So there was a lot of news articles. There was a lot of speak. There were a lot of people who were saying, I'd invested and I'd made this amount of money. And I think that's what initially sparked that interest of me to dive in and kind of get to know more.
Did you invest?
I did, but nowhere near enough.
Interesting. I think that's a question I asked a lot of people who came across Bitcoin, in the mid 2000s or after 2010. Mm-hmm. It's, did you invest? And if so, what is the return like? You also wear a lot of hats, from CVBC to, all the other endeavors that you were telling me that you're involved in. Is there a favorite one that you enjoy on a daily and weekly basis?
So I've got to say, I absolutely love being a VC investor. So, I think only second to being a founder, but just the ability, and I know it sounds kind of cliche because you hear a lot of people speak about this, but just to wake up every day and your kind of job is to help empower young, hungry, intelligent entrepreneurs to kind of make their dreams come true, which coincidentally coincides with changing the world. It's an amazing thing that I get to do. Like I wake up and I'm privileged every day that this is what I get to do on a daily basis. So I think definitely being a venture capital investor is what gets me out of bed in the morning.
Interesting. That's so refreshing to hear. I feel like it's, majority of the population struggle with like finding that excitement to get out of bed every day. Do you think that it's, the medium that you practice, or is it, the empowerment part that kind of excites you? What is it in being a VC that truly, if you had to like pinpoint it, that's that feeling that, gets you out of, or that's the thing that gets you out of bed?
I feel like this is a little bit of a cop-out, but I'd say there's elements of both, right? So on the pure VC side, I enjoy the practice of VC. So understanding things like portfolio construction, target ownership, entry valuations, the exit environment. So the kind of strict discipline of being a VC, in kind of relatable terms, if I was a CA, it would be like saying I really understand or really enjoy IFRS and GARP and kind of what the latest innovations are from a regulatory space. But if I had to choose one or the other, it would definitely be that empowerment piece. I mean, just seeing the excitement and enthusiasm in some of these entrepreneurs and their passion to really solve a problem that is in most cases plaguing millions of Africans, and being able to play a very small part and make it clear it's them that's solving the problem, but being able to play a very small part in empowering them to do that is just so refreshing. And then I'd say extending that, it's really hard to get bored with what you do when every day it's something new and someone's pitching you something at the frontier of innovation, right? Whether it's AI or whether it's a new way to do fraud detection and compliance, or even in our portfolio, right, a brand new way to bank kind of disenfranchised South Africans. It's really hard to get bored when you're just sort of bombarded with these innovative ideas every day.
It's novelty, right? Because you're getting all these new ideas and essentially challenges because you're upskilling yourself as well, and learning, is this the right investment to make? I'm sure that comes with its own challenges.
It's exactly that, right? So if an agri-tech company approaches us, right, we've got to then do our kind of deep dive and due diligence on the agriculture sector and then the specific geography. So the agriculture sector in East Africa, where we see kind of a lot of the agri-tech and agriculture deals coming from, and really understanding, what is the plight of the smallholder farmer? How does smallholder farming work? How does the off-takers that are buying most of this, through global export, how do they find these people? So you're really doing deep dives and digging in and understanding the intricacies of new industries all the time. And like you said, the novelty of that is it's really hard. It's almost like having a new job all the time.
Curiosity is also a trait that I feel like you have to have when you're in that space. Were you a curious kid?
Always curious, but then very obsessive. So if I found something that I really enjoyed, I would go to the ends of the earth to learn everything that I could about that. Growing up, as an example, I was an avid rugby player. I was really, really privileged to kind of be on a full rugby bursary at one of kind of the leading schools in Durban that we were chatting about. And
second leading school.
Yeah. Now leading. We've got some South African school players at the moment, making up a lot of that Craven Week side. But at the time, I could name the entire kind of Rugby World Cup squad with my eyes closed. Every single player, what school they went to, roughly what year they started playing. So I think I was always very curious, but also obsessive. So when I latched onto something that I found really interesting, I would do everything that I could to kind of understand it as deep as possible.
Interesting. So that obsessive trait, I feel like a lot of founders that I come across are super obsessive, but in a healthy way.
Yeah.
Some healthy, some unhealthy, but the healthy obsession, in my opinion, it's not only benefiting yourself, but something bigger than yourself, right?
I think it's so important to be mission driven, right? We see a lot of founders and there's a very distinct kind of palatable difference between a founder that's like, I want to build this business because it can make me a lot of money, or I want to build this business so I can solve this problem that in most cases I experienced or my family experienced for millions of other people. So they don't ever have to experience this problem again. And I think being mission driven as a founder, specifically as a venture-backed founder where you're going to run into so many challenges. We spoke about some of the challenges of being a founder is so critical to kind of give you that perseverance to overcome those challenges. Sometimes money is enough, but a lot of the time, I don't think it's a big enough motivator. So as a founder, I think it's critical to really be mission driven by something bigger than yourself.
100%. But I guess on the other side is, if you're seen as obsessive about what you're doing, then you're kind of cast as this outsider in society because people think you're crazy. You're labeled as all sorts of things. You don't fit in, you don't belong. Have you ever struggled with any of that stuff? The not fitting in part.
So I love that description, and I think it's exactly, maybe counterintuitive. I think it's exactly where founders need to be. By definition of creating an outlier outcome is you yourself are an outlier, which means you should be set apart. You are going to be ostracized. People are not going to understand you. And I've kind of been, I'd say, I've experienced it only through my years of being a founder, where very few people really understand why you're doing what you're doing, believe in what you're doing, why you're still working at 11 o'clock at night. When your kind of peer group is like, come out with us. Your family is like, this is not healthy. So I've definitely experienced it during that specific time frame of my life. But to be honest, I've been really privileged that the rest of the time, I think I've surrounded myself with people who are in their own rights, not always founders, etc., but in their own rights, obsessive about their field of practice, or whether it was peers kind of in the sporting world who kind of really understood it. That I've, for the most part, although it's been a small group, I've been able to surround myself with like-minded people, which I think is also a really powerful tool to get you through the hard times sometimes.
100%. I mean, you find your tribe who then understand you and support you, and may not experience what you're going through, but at least they have the emotional capacity to have empathy.
Absolutely.
Are founders coming to you with these sorts of challenges, with the not fitting in, and if so, what are you telling them?
So not particularly, to be honest. I think a lot of them are so focused on what they're doing that it may not be affecting them, or maybe that it's just not one of the things that they're chatting to me about. Oftentimes, you'll have more than one founder, so your co-founder often becomes that kind of leg for you to rest on, the kind of counterparty to your craziness, if you will. And they become that support structure. And that's why you often see co-founders become like family, throughout kind of this founder journey. They really embed themselves in the other person's life, where they know everything from a personal to a professional level about them. And I think it's a really valuable support structure. Also, similar to horses running races, I think a lot of founders just have blinders on, right? And they're so doggedly focused on the mission in front of them that it doesn't maybe bother them as much as it should, or it could. Again, could just be my personal experience, but one thing I have seen is it's very unfortunate when things break down in that founder relationship, right? So either for personal reasons, or the business doesn't work out, right? And you've given years and years of your life to this. You've sacrificed family time with your children, and those stresses tend to fracture those relationships between co-founders, and sometimes it results in you losing what was your best friend over a business endeavor.
Yeah, I've been there. Well, not a best friend, but a business partner that the relationship went bad. But then for me, I asked the question, was there even a relationship in the first place? And those that are meant to stay will stay, and those that fade away. Reasons, seasons, or lifetime.
100%.
People come into your life. But for the context of this conversation, I'd like for you to just explain some definitions for us, right? So let's start at the basics, beginning Web3. Could you perhaps define what is Web3 for us?
I'm so glad you asked this. I absolutely, one of my passions is really distilling these concepts really, really simply, because I think one of the fallacies of us as an industry is we kind of assume that everyone's operating from the same kind of base knowledge, and we use all this technical jargon and terminology. And I feel this is one of the reasons we've kind of excluded the mass population from understanding and participating in the space. So coming back to your question, Web3 is really just a new way of doing the internet. And there's a great book by Chris Dixon, which is, he leads A16Z's crypto fund out in the US, called Read, Write, Own. And Web 1 was essentially the read era of the internet, right? So, I don't know what the demographics of the audience is, but if you're a little older than me, so maybe in your 40s, you'll know that the amazing things you could do when the internet first came out were very Wikipedia-like, right? You could go to a website and read information on a page. It was this static page, and you were purely a consumer of that information. That was the great innovation of the internet. Web 2 was what we call the write era, right? So we moved from read to read and write. And that was driven in large part by the blogs of the world, the social media platforms of the world. And in this era of the internet, you were no longer purely just a consumer, you were a contributor.
Okay, now you can interact.
Now you can interact, right? I'm scrolling Facebook, I see a post, I can write a comment. I go to Medium, I'm reading someone else's blog, and I decide, you know what, I'm passionate about a topic, I want to write a blog. So you write a blog, people comment. It's now this engaging kind of platform where you could consume and contribute, or you could read and you could write to the internet. Web 3 is the evolution of this, and this is where you can get native true ownership. So Web 3 is defined as the read, write, and own era of the internet. So coming back to the previous Web 2 example, right, and I'm not bashing any company, but if you're on Facebook, Facebook owns your content. Facebook owns your audience. Facebook dictates how and when you can do certain things. So, in the famous example where, political figures, etc., are getting banned, you don't own that audience. You might have 1 million followers, but they don't belong to you. The platform affords you the privilege of accessing that 1 million followers.
And you can leverage that audience, but you don't own
own that audience, right? Exactly. I mean, you can write a post to an audience, but by and large, the platform will dictate whether that post is allowed to go out or not, but also what distribution that post gets. So there's never been true native ownership in the internet economy. What blockchain allows people to do is to finally own things like their audiences, like their usernames. A perfect example is with, I've finally gotten used to calling it X. With X.com, when they transitioned from Twitter to X, there was a user who had the handle X, just X. And the platform just went and reclaimed that handle. Similar to when Facebook rebranded to Meta, on Instagram, there was a user who had, I think, some version of Meta as a username. The platform just went and reclaimed that handle. So with blockchain technology, for the first time, there's a method for you to build internet native applications where the end users have full ownership over their data, their usernames, their audiences. And what you're essentially doing is, instead of building a platform, you're building an interface on top of a decentralized platform, so that if I'm on Facebook, for example, and I've got 1 million followers, and I don't like what you're doing, I can take my audience and I can take my username and I can just pop it onto another interface and I can just carry on using it. So native ownership for the first time is truly available through blockchain technology, and that's what we call Web 3.
Got you. And you touched on it there, which is, blockchain technology. So how would you kind of define blockchain and the purpose of it?
Absolutely. So I could go into the whole really interesting discussion because, I get a little bit of background in math, stats, and game theory. So it's really brought about by this really cool innovation of public-private key cryptography, but this is the problem with the industry, is that's how we explain it. So ignore all of that, right? There's some really cool maths, etc., and game theory and incentive structures that underpin blockchain. But the best way to think about a blockchain is that it's a database. So think about, like, for those who've done accounting in school, this general ledger where it's replicated so many places throughout the internet, and there's millions of copies, that there's no one single person or one single entity that is able to influence that. It's a truly decentralized record of information that is owned by everybody and nobody at the same time. So it's just this really secure way of storing and transacting data with no central counterparty.
Okay. So the uniqueness of it, of course, the first one you mentioned is it's decentralized, right? I can imagine that the second, selling point of blockchain technology is that it's super safe. What other unique factors, or what other factors would you say make it unique?
Make it unique. So I think, like you said, rightly so, the decentralization is one. The second, I think, key value proposition that it provides is it's immutable. And that what that means is that nobody can ever change the information that's stored there. So why that's a problem? I mean, again, just coming back to practical examples, if you're transacting on your favorite banking app, they wouldn't do this, you'd hope, but the bank can literally go into their servers and change your entire transaction history from the day you open your account. With a blockchain, there is nobody in the world who has the power to change what's written on that blockchain. And that provides a whole bunch of different industries and use cases that make it really valuable. But being immutable means that nobody can ever change what's happened on the blockchain. So I think it's decentralized, it's immutable, and I think people often conflate decentralized and distributed, but kind of technically they're two different things. And being distributed means that it's highly resistant, because we don't think about things like this. But coming back to the banks again, and I'm sorry to be bashing banks so much, is that all of your account balances, your transaction history, everything, it sits on a bank server somewhere. And yes, they've got good redundancy methods, right? They've got a bunch of backup servers everywhere. But, if there was some mass, weird terrorist attack where someone destroyed all of your bank servers at the exact same time, your money would disappear into thin air. That money would never exist again. The beauty of blockchains is that the records exist in so many different places around the world that there's no centralized point of failure. And that means that literally, God forbid, but if the entire United States just blacked out and completely went offline, the blockchain and all US people's balances, etc., would just completely function as normal.
Interesting. Okay, so I guess my next question would be around the awareness factor. So what needs to happen from an educational, mindset shift for us to perhaps truly understand the power of this?
Beautiful. So I think, and this might be a little bit controversial to some people in the blockchain space, but I think there's two camps of people, right? Those that are building or engaging with it, that need to understand it. And by and large, that audience kinds of understand it. I think there's a bit more work to do for corporates around legitimization. And I think we're starting to see that with the huge company Stripe, the fintech in the US, buying a stablecoin company for $1 billion called Bridge. I think that starts to legitimize it in the mind of big corporates and C-suite executives who are also really, really important to the space. And the more it's being legitimized, the better the regulation framework, the more incentive they have to start engaging and understanding it. I think they've got the resources to understand it on their own, so that's fine. The second audience is the mass market. And to be honest with you, I don't think they need to understand it. It's the beauty of technology is that it delivers on some outcome without everyone having to understand the underlying tech stack. And I mean, the example we always use in the industry is that we all use the internet every day, but 99.9% of people you speak to cannot explain to you what TCP IP is. We all use emails every day, but no one can explain, how email clients work or how they package and distribute content in kind of bits and packages. The important thing for end users is that we use the technology to produce the best outcomes. And for them, for example, coming back to the stablecoin example, for the average user and I'm a bit biased because we focus on Africa, but in Kenya or in Nigeria, all they want to know is I can send money to my family back home almost for free and almost instantly by clicking 3 buttons. That person, by and large, just needs to know that. They don't need to understand that there's a stable coin in the back end, the blockchain is implementing this, This is the network it's on so that we're minimizing gas fees. The average user doesn't need to know that, and nor do they care, to be honest.
Yeah.
They just need to go, okay, I click 3 buttons and the money goes there and it's fast and it's cheap.
Is there a third audience? So you mentioned first perhaps institutions, right? Then the mass. Is there a third that I could argue are the entrepreneurs solving the problems?
So that's exactly it. So I kind of bucketed them in that first one. Was like, because I feel like a lot of the entrepreneurs either understand it already, or when the time comes, and when we were talking about this dogged obsession of like, when you find out something you want to work with, case in point yourself, kind of digging into the stablecoin space at the moment, they will go and the information's out there, and they will. I don't think there's any trigger that needs to happen for them to kind of go out there, find the knowledge and understand it. So I think the ones who are building in the space already understand it, and the ones who will build in the space will go out there and find what they need to understand it.
What challenges would those individuals have? Because access perhaps is not a challenge. Would it be then, actually building this development?
So very much so. Look, I think we've gotten a lot better as an industry at this. I think when we started out, it was you were writing code and all of these kind of abstract languages that developers weren't accustomed to. And, they weren't kind of the primitives that are available to you today in terms of like just modular infrastructure where you can go, okay, I need this kind of module. Here's a secure version that's been security audited, et cetera, that's built. But I think as the industry is maturing, we're starting to see that infrastructure emerge. And by that infrastructure, what I mean is if you're an entrepreneur who wants to use stable coins in your payments business, you shouldn't have to go and build out that infrastructure from first principles. There should be a company who's done this, who you can just make a few API calls into that have done everything in a secure, compliant fashion where it works the way it should. And I think Bridge is a perfect example of that. So Bridge is a company, like I mentioned earlier, that Stripe purchased for $1 billion. And what they essentially do is they provide this rails and tooling and piping for people to create everyday applications with stablecoins. So whether it's billing, invoicing, payments, it's just a couple of API calls. And I think as the industry matures, more and more of that infrastructure will get built out where the average entrepreneur doesn't need to be a blockchain expert to build with blockchain. They just need to go, okay, cool. I'm going to plug into this company. I'm going to use, 3 or 4 of their APIs or 3 or 4 different APIs, and I'm going to be able to achieve what I want to achieve.
Yeah, that's a really good point. I think when I first started my research, I was very overwhelmed with, where to start.
Yeah.
And then once you start going down the rabbit hole, you're like, okay, actually these solutions have already been developed. And I guess for me, it was figuring out what tools I need to leverage and then, develop the kind of overall algorithm of how the thing's going to work. Because like all of those things are already out there. And especially like with AI tools that are being built, like you can find almost anything. For any solution. I guess my next question would be, are we moving more towards this decentralized world, right? Because you could argue that this technology was developed as a stick it to the man type solution. So are we moving to more of a decentralized world, in the coming years?
You can 100% argue that. And I think the way I view it is there's kind of 2 factions within the wider kind of Web3 industry. You've got the diehard crypto punks who were there at the emergence of the industry, and that is very much their kind of belief system, right, and worldview is that stick it to the man, screw the banks. Like, we don't need the banks. We don't need external third parties telling us what we can do and how we can do things. But I think while we may move further towards decentralization, I think the reality of the average person is very different to kind of that very niche audience, right? And I put it to you this way, because I think the use case that most people understand in crypto is kind of payments and store of wealth, right? So the average person, if they forget their online banking password, or they accidentally, click on a link that they shouldn't have clicked on, there's a whole big infrastructure behind the bank that is there to ensure that we can help you restore your account functionality. were monitoring the fraud on your account. So, those annoying calls that you get when your newsletter subscription goes off, like, we've detected unusual activity on your credit card. As annoying as they might be, they're really there for consumer protection. And the average person requires that, right? The average person is so busy with their life, right? Whether it's your 9-to-5 job and then raising your kids and then maybe you're studying on the side. Like you don't have the mental capacity to be able to go, okay, I'm going to take complete ownership and responsibility over my financial accounts. Because a similar example in kind of the crypto world is if you have your own wallet and you've got the private keys to that wallet, which is essentially like your password, and you lose that, your money is gone forever. There's no helpline that you can phone. There is no, Bitcoin doesn't have a support desk. There is no one that you can phone to say, hey, is there some way that you could possibly help me? That money is gone to the world. It will never be transacted. It'll be stuck in that account and never be able to be used for the rest of history. And the average person does not want to operate in an environment like that. So, again, a little bit of a counter or unpopular opinion maybe. I do think this technology will help us move further towards decentralization. So it will help disintermediate some of that high concentration of power you see, for example, in the big tech companies. So coming back to the Meta example we touched on earlier, that's one way that you pull some of that power away from a massive company like Facebook or Meta, but most people know it as Facebook, is you create this back-end infrastructure where they're just providing the interface and not the whole infrastructure. But do I think we'll go full kind of cypherpunk, everybody has their own wallet and they custody their own private keys? And no, I think that's not a pragmatic approach for most of the population.
Yeah, I think, what you're making me think about is this issue of timing and how early everything still is. Yeah. I mean, I still believe that even AI, super early. Like companies that are building, I feel like there's some good solutions out there, but for the mass majority of the world, super early. The adoption, still way too early. So, yeah, I think I agree with you on that. But yeah, who knows? Like the rate at which things are developing is faster than ever before.
Unbelievable.
So you can't say that, the next 10 years are going to be the same as perhaps the previous 10 years. I mean,
I completely agree.
Just by looking at that. So getting into crypto, let's go into definitions.
Let's do it.
So in terms of you gave a bit of background on perhaps Bitcoin earlier, but how was the first digital currency developed?
So, I mean, this is a story where, because of the pseudonymous nature of the creators, we really can only draw on, some early blog posts, some early emails from some of the early contributors. So we'll never know in detail the 100% true story unless, Satoshi, him or herself, pops out of the woodwork one day, decides to write an autobiography.
Imagine.
But imagine. Crazier things have happened. But essentially, there was, as we all know, the massive kind of 2007, 2008 financial crisis. And this was really driven by a small handful of bad actors in the US economy who were using things like derivatives and these other financial structures, complex structures that people create to kind of obfuscate things. And what was unfortunate is that the poor behavior of the small group of actors resulted in massive worldwide economic turmoil. And the creator or creators of Bitcoin looked at this and they said, there's got to be a better system. There's got to be a better way that we can do finance, right? Than relying on kind of the poor incentive structures with, a handful of bad actors. And that's where Bitcoin really emerged from, was the vision. And I mean, again, if you go back and you read that kind of 8-page document, is a global decentralized version of money, an electronic cash, if you will. And Bitcoin actually wasn't the first time this idea had come about. So from, I think, the 80s or the 90s, people were using concepts like cryptography, etc., to try and build new ways of internet native money. All of them had failed. So I think Bitcoin was the first time where someone was able to use technology to really kind of solve a couple of key problems, like the double spend problem. And
Sorry, what's a double spend
so the
problem?
double spend problem is exactly why we have kind of internet banking infrastructure and internet payment companies, because if I take 100 Rand and I put a representation of that on the internet, it would be a very, very big problem if I could take that same 100 Rand and send it to you and then also buy some groceries at Pick and Pay,
Okay,
right?
got you.
I mean, it'd be nice for me, but it would be a really big problem for the way the financial system works. And that's why we have these financial companies or intermediaries who sit on the internet. Either it's the bank through online banking, or it's a fintech or payments company who, as soon as I send that 100 Rand to you, they go in and they look and they go, okay, does Brenton have the 100 Rand? Yes. Is he allowed to send it? Yes. Have we removed it from his account? Yes. Have we allotted it to Nason's account? Yes. Okay, everything checks out. And the reason we have these intermediaries who take all of these fees, etc., is because the internet protocol wasn't designed for transfer of value. Because if I have a meme, right, I can make 100 copies of that meme and share it to everyone, which is good. That's how the internet should work. But if you replace meme or research paper or Instagram post suddenly with a 100 Rand note, that becomes a big problem. And that's the double spend problem, is how do you prevent people double spending monetary value? And we haven't had a good answer for this, ever since the invention of money. And how that's been resolved on the internet native side is we've had these intermediaries who've done exactly what I said. But using maths and cryptography now, Satoshi and the initial Bitcoin contributors have solved that double spend problem, where you don't need a third party to go, Brenton has 100 Rand check, Brenton has sent 100 Rand check, where the maths and the cryptography involved does all of that work for you.
That's super interesting. Okay, so why? Okay, I guess we spoke about the adoption a bit earlier on, but my question was going to be, this seems like such a sure thing to be used as a means of trade, right? Are we going to get to that point in the near future, or is this very much a similar conversation to what we were having earlier about still being way too early?
So that's a really interesting question. I mean, I think in practice, what's happened since the introduction of Bitcoin is the initial vision was a digital cash system, right? But what we've seen in practice, just because of the way the Bitcoin network works, is that for the average transaction, it's a little bit too slow, it's a little bit too expensive. So people have actually started looking at it and treating it more as a new version of digital gold. So it shares a lot more of the properties with gold than it does maybe as what we need for an eCash. And these kind of properties are things like it's divisible, right? So I can take one Bitcoin and I can divide it into hundreds of thousands of units, right? So I can send 0.000001 Bitcoin if I needed to. It's fungible, which means that if you have 0.1 Bitcoin and I have 0.1 Bitcoin and we swap them with each other, it's the same thing. We don't really care, right? My 0.1 Bitcoin is no different to your 0.1 Bitcoin. It's highly transportable, right? So that's one of the issues with gold as a form of money, is all good and well when you've got 100 kgs of gold sitting in a spare room in your house, but try and get that across to Switzerland. It's a big problem. And then obviously having a digital native version of that makes it much simpler. So because of that, people have started treating Bitcoin more as a long-term store of value and as a version of digital gold. And particularly why it's so valuable is that it's also highly predictive. So Bitcoin will only ever have 21 million Bitcoin.
Okay.
It's programmed into the protocol. Nobody can change the protocol. And because of that, there's a high degree of certainty that the scarcity will remain. Whereas with gold, one of the many reasons people use it as a store of value is because we've kind of got a rough estimate of how much will be mined every year, so how much will be added to the supply. So we can kind of predict what that supply will look like at some point in the future, but it's not completely accurate. I mean, if SpaceX keeps going at the rate that it's going, and suddenly we're able to mine rare earth minerals, etc., from asteroids, we could just bring in 500 tons, etc., of just new gold into the supply, and that'll completely change the scarcity value proposition of it. So, will we see it being used for trade? Potentially at a nation state level. Will we see it more used as a uncorrelated sort of store of value without kind of geopolitical issues? So in saying that, like, it's all good and well that a lot of emerging market countries use the dollar as a store of wealth. But if they decide they don't like your economic policies, or they decide to sanction you, I mean, it might be a bit too soon now for South Africans with me saying that. But then holding dollars becomes an issue for you. Whereas Bitcoin is completely uncorrelated to any political ideology, any sort of specific country or regime. So I think in practice, at least in the short term, will much more likely see it used as a store of value. And that we're starting to see in practice already. So, everyone from El Salvador adopting it as a method of transacting, but more as a part of a strategic reserve. We've now seen a couple of countries out in the EU say they're starting to research adopting Bitcoin as part of their nation's strategic reserve. And I think it was just over the last few days that Donald Trump has come out and said that a big priority for the US is doing research on establishing a Bitcoin strategic reserve. So I think we see it act more as gold in the short to medium term as a method of transaction. But what that means is potentially for the future is if all these different nation states are holding it, it could become this independent third-party method of settling trades between nations. At that level, the speed and cost is fine.
But something else that I was thinking about was, so now you're describing it as being an asset class, essentially, right? So could you explain to the average user, how did this become so valuable? Like, what gave it the spike and the value?
Absolutely. So I think the best way to understand it is the same value proposition that gold has, right? Because I mean, a lot of these assets, it's just shared belief system that creates value. Because with gold, for example, people might not know this, but gold is not valued at where it is because of its production value. So it's like, people buy gold because I can use it in transistors, or I can use it as a conductive material here. It's a store of value because of certain properties that it has that we were speaking about earlier, right? Specifically scarcity. And Bitcoin's interesting kind of feature is this proof of work, which the equivalent in gold is gold doesn't just appear from the sky. I mean, unless, we spoke about SpaceX, but you've actually got to find a gold deposit. Then you've got to put in time, effort, and money to pull that gold ore out of the ground. Then you've got to process that gold ore and refine it. So there's a lot of work that goes into processing this, and there's a defined scarcity of that asset. So those are some of the drivers of why people hold gold from an asset class perspective. Bitcoin shares some of these exact same traits in a more digitally native version. So with Bitcoin, it doesn't just appear out of thin air, as some people may believe. You've got to do these intensive proof of work transactions. Again, no need to go into the technicalities. Mining, exactly. So you've got to expend a lot of energy in terms of electricity, in terms of compute, to be able to produce a Bitcoin. Similar to the mining example. Then when it comes to scarcity, it's very clear in the open source code that anybody can open, anybody can verify. How new Bitcoin is introduced into the system, at what rate it's introduced into the system, and how much there will ever be in existence, which is 21 million. So because there's that defined scarcity there, the supply schedule is almost set for all of eternity. So as the demand function starts to increase, for those who did eco, the supply chain, the demand curve shifting up and down, the market equilibrium price becomes higher and higher as the demand grows more and more. Because, like I said, that supply function is set for all of eternity. We know exactly, we can predict with a high degree of certainty exactly how much Bitcoin is going to exist in, by the 19th of December, 2032, which is a very unique property to be able to have with an asset. And those are kind of the two core value drivers. The third being, depending what time frame you look at it, the lack of correlation. So, coming back to kind of asset allocation theory and kind of portfolio theory, there's no point in me buying two stocks that move up and down together, right? Because I might as well just put all the money in the one stock because they do the same thing. Similar to Bitcoin as an asset class, there's no point in me buying Bitcoin and stocks if they both do exactly the same thing. But over a long period of time, you start to see Bitcoin actually being uncorrelated from other asset classes. And from an asset allocation perspective, so if I'm a financial advisor or for my portfolio manager and I'm looking at, okay, I've got $1 million, what's the best way to cut this $1 million up in terms of the pies and allocation? You really want to put a bunch of things into that pie that don't move up and down in unison, i.e. are not correlated. And Bitcoin provides that uncorrelated asset allocation as well as the lack of geopolitical ties. So, if China comes out with a new trade tariff, if Donald Trump, starts issuing tariffs against Canada, if Russia invades Ukraine, all of these things have absolutely no bearing on the value of Bitcoin. Whereas other commodities like wheat, like gold, these things are affected because either a portion is mined in those locations or tariffs changed kind of the demand and supply functions of those. Whereas Bitcoin is completely devoid of kind of geopolitical ties.
Okay. So from the average, call it investor, so young working professional, have a bit of cash, like say I've saved up 100,000 in the bank. Cool. Now this money is just sitting there and I want to diversify. So, based on the analogy you gave earlier of, you're not going to invest in a stock and Bitcoin if they're doing the same thing, right? But where does diversification come into this? And, for that very early investor who wants to, grow his capital, he or she wants to grow her capital, what are you telling them in terms of diversification?
So I'll premise this with a famous saying in the crypto space, which is not financial advice. NFA, it's a funny joke within the space. Whenever you're about to say something, you always say not financial advice. But although I'm a huge believer in crypto, although I have an irresponsibly high allocation in my personal portfolio, the average investor, what I advise them, and this is backed up by kind of some of the largest asset managers, et cetera, in the world, is that depending on your risk tolerance, which is kind of a function of your age, right? Because if you're 60, you're not really looking at assets that are going to produce growth in the next 30 years, right? Whereas if you're 20, you're very much looking at those high growth assets. But there's a band of allocation between kind of 2 and 10% based on what your risk appetite is, which again is based on a number of factors, that is an advisable allocation to Bitcoin. So, if you're young, probably the upper end that you should do in terms of an allocation is about 10%. And 5% is actually the absolute sweet spot from a portfolio construction perspective, according to a lot of research done by, these multi-billion-dollar asset managers, where it creates this really interesting dynamic where, worst case scenario, because this is how they need to think, if it goes to zero, the maximum drawdown to your net worth or your portfolio is 5%, right? You can't lose more than you've put in. But because of the historical returns of Bitcoin, I think the compounded annual growth rate is sitting, very high double digits at the moment, is that it can actually be the biggest return driver in your portfolio while only having a maximum at-risk value of 5%. So it might drive 2, 3, 4% of your overall return in your portfolio, but the max that you can lose if everything goes to crap is zero. Sorry, it's 5%.
Yes. So when you said that you are extra risky, like how is your portfolio divided?
So again, I do not, I want to premise this with saying I do not advise anybody to do this. And also because I've been through so many cycles, like, you can see things like happened the other day where the market drops by 20%. And the average investor, if you see that and your portfolio is down 20%, like it's going to cause some pain and some anxiety. For me, it's like, it's another Tuesday.
Okay.
Because I've been through so many cycles. But and again, this is very, very, the financial advisors are probably going to have a heart attack who listen to this. But my portfolio is roughly, at the moment, probably about 70%, 80% crypto, 10, 15% angel investments in startups, and then like 5, 10% cash.
Okay.
So not great portfolio construction, but as you can see, I really do drink the Kool-Aid. I believe in the space.
Yeah, that's actually interesting that you mentioned that because, the people that I've researched online and also spoken to who like believe in crypto, they are the ones who have the biggest percentage of their portfolio invested in crypto, which I find amazing, right? So it's...
that tells you that the true belief is there, right?
100%.
We're not just talking our book, is that we really believe in what we're doing.
Yeah. And of course, like there's many different coins that were established, not just Bitcoin, right?
Yeah.
As a form of crypto. Pumping and dumping is a term that I also recently, a couple of years I heard about, all the stories that were going on. But, could you perhaps elaborate on what pumping and dumping is?
Absolutely. So, it gives the industry a really bad name. And then this comes back to this pros and cons of kind of running this kind of decentralized retail first market. So a lot of people, because they saw kind of the exorbitant money that some people made in Bitcoin, like you said, invested back in 2015, 2016, and even from other coins, right, that have done 10x, 20x, 30x, 50x returns. People want to chase that next return like that. If you heard about your friend who put 10,000 Rand into Bitcoin or into another crypto coin and cashed out 500,000 Rand, of course you're going to want to do the same thing. So because of that, people tend to shy away from your more established cryptocurrencies because they're like, oh, that's already done well. It's already made people the money. And they start to look to these hype-driven, smaller cryptocurrencies where they're like, oh, it's only, 1/10 of 1 cent. If this goes to $1, I can make life-changing money. And it's really driven by greed and people chasing this return. And that is what people are exploiting when they launch these pump and dump schemes. So what they'll do is, there's a bunch of different ways that people do this, but maybe the famous one is people, kind of onboarding or exploiting celebrities. So they'll bring on, like a Floyd Mayweather and they'll say, hey, here's $1 million. I want you to promote this coin and just say that it's the next best thing. That's all you got to do. Make 3 tweets and jump on an Instagram video with me and say, this is the next big coin. And everybody, millions of people watching are going to go, oh, this is how I'm going to make that life-changing money. And they put all of their money into this coin. And the creators on the other end, when the coin's gone up 30, 40, 50 times, they just sell and they dump on you. So the pump is that initial part where they create hype and excitement and they're like, oh, this is going to be the next best thing. You're going to make life-changing money. Put your money into this. And by you putting your money into it, you pump the price up. And then the creators who are exploiting you on the other end, what they do is they cause the dump. So they sell all of their token allocations, which they've got for free, and they cash out millions and millions and millions of dollars, which causes the price to crash most times to zero. And that results in all of these retail investors losing all of their money.
And this is legal.
And so now it's a little bit less legal than it was. Early on, it was a gray area. So because it was an unregulated asset class, these kind of activities were unregulated. And a lot of people exploited that in the early days. So
yeah, that's crazy.
It's unbelievable.
So if I'm essentially invested, $1 million, $10,000, and that $10,000 rose to say $10 million, and then the next day I don't check the balances when it's actually coming down, like that $10,000 is gone.
Gone, completely gone.
I see.
And it's not even a thing of you not checking, is that it happens so quickly that it could be literally, you check your balance and you're like, oh, my 10,000's gone to $100,000. You check 5 minutes later and it's zero. Because that's the point at which the creators in the back end have just completely cashed out.
Binance.
Yes.
You were instrumental in the growth of Binance to, sub-Saharan Africa and other parts in Africa. What were you doing differently to kind of, spearhead that growth?
So it was actually a very interesting time of learning for me. So prior to that, a lot of the business I was doing, a lot of it was entrepreneurial in the consulting space, in the venture studio space. It was kind of focused on South Africa. So I kind of had a decent grasp on the South African consumer, right? What drives consumer behaviors, what's kind of the objective function of these users, how to kind of segment the market, what the different archetypes of users look like. With Binance, it was a really interesting opportunity because it was really the first time I executed a Pan-African role at that scale. And what I learned on the fly was that the average Kenyan user is very different from the average South African user, which is very different from the average Nigerian user. What drives their behaviors, how they think about digital assets or consumer products in general, how many touch points you need to onboard them, what are the kind of predominant channels of engagement, all of these different things are very, very different across the different kind of African regions. And to be honest, it was like, it's a very dynamic, intense environment at Binance where, you're always pushing for maximum results. And because of that, like I said, I was really privileged to learn a lot on the fly. I feel like my ex-colleagues and I always joke it's like a MBA wrapped up into a work experience because you learn so much practically. Like Naval Ravikant says, the only way to learn truly is by doing. And that was a really interesting experience for me. So I learned, everything from the regulatory nuances and environment of East Africa, Francophone Africa, Sub-Saharan Africa, to customer and consumer behaviors, to how corporates utilize the technology, to what compliance looks like in the different regions. And that was very interesting for me because in my experience today, I really see that in practice in that South Africa and Kenya are really so different that if you're an African company looking to launch into those markets, it's almost like you could say I'm launching in South Africa and Brazil. It's two completely different currencies, different regulatory regimes, different consumer behaviors. It's a completely foreign place.
Different cultures.
Different cultures. And that's why I understand the plight of kind of the African startup entrepreneur in that, each market is so small that you've got to be multi-market, but it's so hard to launch into new markets. It's almost like launching into completely foreign lands. Like I said, like Brazil or Southeast Asia, the complexity is just as much in terms of the differences across all those different areas. But I was really privileged that, it seems like I learned quickly on the fly and we managed to scale all of those markets to kind of, we were the number one in the region within 6 months of launching in each of those respective markets.
Wow.
Apart from South Africa, we've got some big players here. But we were in the top 3 here.
It also seems like, a key to that would be perhaps establishing those strong local partners on the ground. People that understand the nuances of the land, of the ecosystems. And I think that, that's what I learned about when you're scaling into other regions. If you're perhaps a product-based business, understanding consumer behavior, and as you said, learning on the job, that's perhaps like the most important part. I want to talk about, the barriers to entry. So that entrepreneur who wants to develop a solution, using blockchain and, perhaps, a stable coin or let's just use blockchain.
Yeah.
From a finance point of view, I can imagine that, funding is a challenge for that person.
Absolutely.
Talk to me about regulation. What barriers are there when it comes to that environment?
So to be honest, that's been one of the biggest constricting factors in getting people to build in the space historically on the African continent because, think about it. If you're the average entrepreneur, do you want to build in a space where you've got this lack of regulatory clarity and we've seen this in practice in regions like Nigeria with the Central Bank of Nigeria, where overnight they just completely changed their position on the technology, which means you could have spent hundreds and thousands of hours, tens of thousands of dollars building a business that tomorrow they might deem illegal. And because of that, people were very hesitant to build in the space, but also the most talented entrepreneurs were really hesitant to build in the space. So if you're, I'm just using an example, if you were in the innovation division at a bank for the last 10, 20 years, you really intimately understand the banking and payment space. Are you really going to take a risk in your career, in your livelihood, to build in a space where overnight your business could be deemed illegal, or the way you're doing business could be incorrect and you'd have to completely shift and pivot? So without that regulatory clarity, a lot of the most talented entrepreneurs won't build in the space, but also capital won't flow in the space. So if I'm both an investor or a big corporate, right? Say I'm an ABSA or a Standard Bank or an FNB, I'm not going to invest time and effort in the space where there's no regulatory clarity. One, because it could be a waste of money, but two, because it has a massive reputational risk to an organization like that. So until the rules on the field are set in stone and very clear, entrepreneurs don't want to invest their time, investors don't want to invest their money, and corporates don't want to invest their time and money. In saying that, I think we've seen some amazing developments over the last kind of 18 months. So South Africa has introduced the crypto asset service provider licenses, issued, I think it's about 248 licenses today to just short of 250 licenses. And this means that the entrepreneurs have the clarity they need, the corporates have the clarity they need, the investors have the clarity they need. Kenya recently published their draft bill on crypto asset regulation, which means, clear regulation and licensing is just over the horizon. And Nigeria issued their first 2 licenses in principle, I think it was in Q2 or Q3 of last year. And those are the 3 biggest markets on the African continent. So likely a lot of the smaller kind of countries in those regional blocks will follow suit. So regulation has been a big hindrance, but we're starting to get over that roadblock now.
Yeah, I really have empathy for that founder. Because, they're not only dealing with the challenges that come with, starting and growing a business, but now you're dealing with something that's very much out of your control.
100%.
I think, one of the biggest things I learned last year was dealing with the uncertainty of things. If you can accept that things are uncertain and focus on what you can control, you'll be ahead of majority.
Exactly, 100%. So focus on the things that are within your purview, and just the rest you have no control anyway. So why worry about it?
Hope and pray.
Yeah, exactly. I was actually going to say, it's a good element of faith is a good thing to have there.
In this season of your life, what drives you?
Very interesting. Look, I think in this season of my life, really sharpening my skill set in being a venture capital practitioner. And I think we were chatting about some of the skills earlier, right? Just really understanding some of the nuances that allow me to best serve my founders. So things like corporate structure, like fundraising, like governance, all of the things that might not be the core bread and butter of a startup's business, but are really still important to them, that I can kind of step in and help with and around that. So I think really acquiring and sharpening my skill sets that allow me to add the most value to the founders that we invest in is a big focus for me at the moment. And then interestingly enough, I haven't really started to push it, but I think you're doing a great job here at the African CEO. Is a lot of people are of the opinion that the future of venture is not going to be firm-based, but it's going to be brand-based. And I think what that really means, and I don't think it's just purely the future of venture, right? I think it's, and what this means in practice is that going forward, people are not going to want to do businesses with the big shiny logo. They're going to want to do business with the person with a strong brand who they trust at the firm with the big shiny logo.
Are you talking about the average consumer, or?
Both the average consumer and the average founder.
Okay.
So the average consumer is gonna want to buy fintech products, for example, through the YouTuber who's been doing financial education for them for 5 years, right? They're not gonna care about a pink logo with a yellow flower, right? That's irrelevant to them. They're gonna want to build that trust and that rapport with someone who is a content creator, and then as a function of that, sort of get their financial products, etc., through that channel. And I think the same translates, or the same future of consumer behavior is going to translate to founders, where founders are not going to want to do business or take money from this big, shiny brand name firm. It's going to be all about the partners that are at that firm, and how closely they resonate with them and their content and their worldviews and their kind of subject matter expertise. So a big focus, which I haven't kind of invested a lot of time and effort into yet, I think is going to be building my personal brand going forward.
So yeah, what I was thinking about is a challenge, because essentially the VC in this example is a marketplace, right? A marketplace to get capital, and then a marketplace to deploy that capital. Yeah. So on the one hand, you are attracting founders because you want strong pipeline and investable deals. 100%. But then on the other side of it is you are attracting money from institutions, family offices, high network individuals. And so it's difficult, because I can imagine on the one side, those individuals would want to see a track record, would want to see the big shiny logo and, the legacy. Whereas on this side, they want to see all the things you're talking about. So how do you solve that problem?
It's a problem I think we're still solving on the African continent specifically when it comes to venture. And that's the track record space, right? Depending who you kind of speak to, the industry really is 10 to 12 years old on the African continent. And the average venture capital fund is about a 10-year lifespan. So in terms of track record, there really isn't much, if any, track record as an industry for us to point to and say, hey, here's proof that African venture capital is a good investment. Hopefully in kind of the years and decades to come, we'll be able to produce those proof points. But there isn't much track record to look to at the moment. So it's all really been based on kind of this theoretical value creation around things like the demographic dividend in Africa, the size of the addressable market, the emergence of a strong middle class. And I think there as well, personal brand is still a valuable asset. I mean, if you look at a Jason Calacanis, for example, prolific angel investor, probably one of the best known angel investors in the world, co-host of the All In podcast. He's built a personal brand that has given him a differentiator, because like you said with this marketplace, capital is a commodity, right? A dollar is a dollar. What differentiates you in being able to receive that dollar and deploy that dollar are things like your personal brand. So people knowing you and resonating with you, to be able to trust you enough to deploy that dollar into you, and then founders resonating with you in the way you work and your worldview and the depth of your subject matter expertise, to want to take that dollar from you versus that dollar from the next person. So to be honest, capital raising is on a large scale is still a challenge for all African VCs. The majority of that funding is still coming from organizations known as DFIs, or development finance institutions. A lot of it is still impact capital and kind of like charity. Africa is viewed as a kind of charity case, and we really want to, as an industry, change that view, right? Africa is a great place to do business. We can produce great returns for you. But I think it's just going to take a couple more years for us to be able to prove that in practice and change that narrative to where people are not deploying capital into African funds anymore because it makes them feel good. They're deploying it because it's a strong investment decision.
100%. I think, what you're speaking about there, which is what I was thinking about, the golden thread being authenticity. So on both sides, it's people dealing with people, regardless of perhaps, how it's perceived on either side. If you can be authentic, I feel like, you can get what you want, especially with those that resonate with you.
It's the one thing ChatGPT hasn't taken from us yet.
Brenton, the last part of the podcast is called the Fast Fire. So if you could answer in a short sentence or a word, that would be quite cool.
Let's do it.
So you mentioned an unpopular belief early on, but if I had to ask you, what's a contrarian truth that you believe to be true? What would that be?
If you really want to be exceptional, there's no such thing as work-life balance.
I agree with you. A decision you wish you made in your 20s?
To invest more time in doing and less time in learning.
Interesting. So you felt that, okay, yeah, just a follow-up question. So for you, I'm just assuming that by doing, you would have learned a bit more?
Yeah.
Okay. Something you want to leave behind that, no longer serves you from a either professional or personal point of view?
That's a very interesting one. I mean, I've been for a while trying to prevent myself from consuming so much mindless content, which I think is a problem for all of us. But yeah, I mean, I think I'd be able to squeeze out a few more productive hours in the day.
Digital distractions.
Yeah, exactly.
One piece of advice to founders who want to get into the blockchain Web3 space
is always remember a blockchain founder is a founder. So obviously learn the technology, but we don't want to hear about the technicalities of what you're doing. At the end of the day, you're still solving a real problem. Blockchain is just a tool for you to do that. So focus on the problem you're solving and make sure that blockchain is the best tool to be able to do that, because a blockchain business and a business are the exact same thing. It's just the one is utilizing, I mean, as a tech startup, you don't say, I'm an internet startup. If you're using the internet, that's cool. If you're using blockchain, that's cool, but you're still solving a core problem. Focus on that core problem.
Brenton, thank you. Is there anything that we did not speak about that you feel that you need to share?
Not particularly. I mean, thank you so much for having me. I've really, really enjoyed this. I love kind of the brand that you're building at the African CEO. One nugget is, I think, if you're looking at something to focus on for the next decade on the African continent, don't sleep on stablecoins. I think stablecoins are really going to become a key component to the future of fintech in general. So definitely, if you're looking at building a fintech business, make sure that you really intimately understand stablecoins. I think they're going to create billions of dollars in the African continent in the years to come.
That's amazing advice. Thank you, Brenton. Thank you. This was super insightful. Thank you for your wisdom. I learned so much. I really feel like you are an expert in this field. So thank you for the work that you're doing.
Absolute pleasure. Thank you so much for the kind words.
No problem.